And this maybe will take care of one question we had earlier that asked us if we had done anything with the Forbes Best Small Company list. Those of you that have been around Manifest for a while know that we go gaga during the Halloween period when we're trick-or-treating. We're also thinking about the Forbes.com release of the best small companies, and we typically will subject them to the gauntlet. There's 100 companies listed, and these happen to be among those that ranked highest. This is sorted by quality. And it's the 16 that kind of attracted the most attention. You'll see many familiar names. There's a few that are within the portfolio for the roundtable already. Two that caught my eye simply because of the higher returns were portfolio recovery, and then basically the same type of quality and very high return characteristics, along with all this other wonderful tendencies that you see for this company that I had not heard of until a week or perhaps a month ago. Not paid much attention to it anyhow. Ken asked me to take a look at Masimo and try to find something wrong with it. I can't find anything wrong with it, Ken. Very financially strong, very stable. We'll take a look at a couple pictures here in a minute, but that's the one I decided to go with. And again, if you want more information on this, you can go back to the dashboard diagnostic session, and they're on the Forbes 100 list, but it's a good source of potential studies. Here's a quick look at Masimo from the value line perspective. You can see that, again, this is our quick triple play check. We're looking for the depressed stock price, kind of been in a trading range that you can see here for the last several years. The result of that, because the company's fundamentals have been steadily improving, we'll see that on the next chart, but we really like this low total return forecast because that's the value line's work of 22%. So that meets the first criteria. The second criteria is for the current PE ratio to have the potential to expand to a higher figure down the road. In this case, 3 to 5 years out, we see that value line is projecting a 25 here. So if we can convince ourselves that that is feasible or possible, we have the first two conditions of the triple play met. The third condition is for a favorable profitability picture. Come down here to the net margin profile, and we see a company that has been in the 15 to 16 range value line. This can be a little bit optimistic, but at least they're projecting for an improvement or a bolstering of the profitability at the company. So it actually meets all three conditions. There's one more for a bonus. This company has no debt, even though there's a trickle reported here. That's basically nothing, considering that they've got way more than that in their checkbook, in their cash equivalents. So all three triple play conditions are met. What does this company do? Basically, it's in a very, to me, strategically important area of non-invasive medical stuff. They do blood tests. For instance, if you've been on a treadmill lately, you can put your hands down on the bars and they actually measure the heart rate, all that kind of stuff. There's all kinds of devices out there. Well, these guys are in the blood testing and certain non-invasive type tests for medical purposes. Pretty interesting, and what I think will be a highly strategic area. Here's a look at the visual analysis, so we can see basically the track record of the company, including a couple years of forecast. So you can see we've got a very nice picture developing of actual results here for their sales, and then expectations that are real nice also. Of course, the earnings are tracking pretty well, and it doesn't get any more up straight and parallel than that. So these two are operating just fine, and as we said just a few minutes ago, with these strong trends in sales and earnings, combined with a stock price trend which has been going this way or relatively flat, that basically is the road to opportunity. We see a company growing somewhere in the low teens. In this case, we're going to use 14% based on the characteristics that you see there. Profitability, just a quick look at the profitability. It has been improving. Here it's projected to improve in 2012, and the expansion, at least according in the world of the value line analyst, will improve appreciably up into the 17 range. Even if that doesn't happen, even if it comes in somewhere in here, we're still talking about a real nice picture, real nice profitability picture, even in the 15, 16, 17% range. So we'll probably just stay on the low side. The worst it's ever been, it's been down in the 15% range the last 3 years, so we'll use 15. Here's that equity analysis guide that Cy just mentioned. Again, we're using 14% for the growth expectations. We're using 16% for the margin, again, kind of in the middle of that range we just looked at. We use a PE ratio of about 22, not even going up to the 25 suggested by Value Line. This one, of course, is influenced also by the work at Morningstar and S&P. We end up with a confirmation and something credible that is possible to be a 20% projected annual return for Masimo. So with that, that's our selections. We're going to double down on Walgreen and make that a 4-time selection. We'll double
Mark,
down on ResMed.
Can I make a point about Masimo and one of the growth drivers for this company that I think is really important? Basically, this company sells all of its products right now to be used by hospitals in intensive care situations. They're doing all kinds of non-invasive monitoring of patient health in intensive care situations. The company is very optimistic, and so are most of the analysts that follow this company, however, that the new market is going to be moving this non-intensive monitoring material from intensive care into normal, everyday hospital care. And so as hospitals go on to their next cycle of purchasing, some of this equipment is going to be purchased to be used in the regular hospital setting, and that's where a lot of the money will be made going into the future.
And Ken, are you comfortable talking about the connection within your investment club to your awareness of this company?
It wasn't this company, Mark. It was IPCM.
Oh, I'm sorry. I'm thinking of another one of your presentations. I was just trying to steal from you again. Anyhow, we've got the stuff up here that people can take a quick look at. We'd recommend that you take a closer look at the company. By the way, in a market that was absolutely demolished today, I think Masimo was up 2 or 3%. So we're not the only ones noticing, at least for today. So with that, that's the end of our formal program. We can leave the floor open for questions and answers, and we usually try to wrap up within the next 5 or 10 minutes. But if anybody's got anything on their mind that they'd like to explore, just let us know.
Mark, Nancy would like to know, is there any place that you can go for reliable growth rates, especially 5-year growth rates?
Well, we look at when you know what you're dealing with, they're all reliable. If you're dealing with an analyst report, whether it's Value Line or Morningstar or whoever, it's where this breaks down is where they try to average them all together and build this so-called consensus. That's where the breakdown happens. But when you grab a report from Value Line and take a look at it, that's reliable. There's nothing wrong with that at all. I'll tell you though, my personal opinion is the most reliable one is the one that you construct as you do your own stock study, where you've got the numbers involved.
Yeah,
you know exactly what you're looking at. For example, just as another cautionary tale, when you're dealing with Value Line, anytime there's mergers and acquisitions, sometimes this period that you see here can get quite messy. Can be very distorted by mergers and acquisitions for any particular company.
And another potential disorder, you pointed out the problem there with that figure, Mark, but also just be aware of the methodology that the analyst follows. Value Line, for example, I think almost exclusively, I can't off the top of my head think of any projection that includes mergers going forward. They always look at just organic growth. So for example, a company like a Cisco or something that is a serial acquirer, Value Line will almost always have a relatively low sales growth projection because their methodology, they just don't take into account future mergers. Whereas Morningstar, which is another source that I know you use and I use for 5-year sales growth, double checks, if you will. Morningstar does sometimes, and in fact usually does for companies that do a lot of acquisition, include acquisition in their projection.
Mm-hmm. And here, just to reinforce the point, Sherry, here's Massimo. I'll tell you who I trust. I trust me. I mean, that's 14%. And you're not going to be able to get me off 14% unless you've got a fairly heavy tool or one of Hughes and Spears. If you come over to Finance Yahoo, you'll see that the number here is 21.1. That's probably distorted by precisely what we described. Let's see how many analysts.
Be interesting to start looking at Yahoo and look. Well, there's one analyst, and then two.
Oh yeah, we do that.
For another company. Yeah.
Yeah, it's one of Ken's precautions for small companies for sure.
Yeah, deconvolute what they're up to there.
Yeah, they can whipsaw you pretty good when you get into one of those. All right, I'm showing 9:53. We generally try to be done by 10, but we'll stick around as long as people have questions.
Mark, we're getting a comment/question from Noelle. She'd like to hear what you think about the fact that Massimo has paid so many special dividends in the last 3 or 4 years.
Well, I'll let Hugh handle that one. He's a dividend guy. Let's take a look.
When did that happen? I'm still hoping Microsoft will get rid of their multiple $billion that's sitting on their balance sheet. I don't know what it's doing there. I'm
just looking to see. I'm not showing here. She's talking about Massimo, right?
Yeah, it's down in the footnotes on the value line page, Mark.
Yeah.
All right, you're teaching me. See, I haven't had time to study it in any great detail. Oh, cool. All right, well,
the good thing about doing a special dividend is it doesn't create expectations on the part of shareholders. So I guess if they're uncertain about their cash needs going forward, they can declare it as a special dividend in a regular period, and then, there's not the expectation that it's going to happen again in 12 months or 6 months or 3 months.
That's pretty cool. Those are large.
They are big chunks, yeah. And, it's a good way to avoid the takeover as well. If you have a lot of cash in your balance sheet, you probably want to get rid of it some way. If there's nothing you can buy or you don't need to reinvest in the company, well, just give it to your shareholders.
It's a fascinating topic to take a little bit deeper. Go ahead, Si.
And I was just thinking, Noelle, in her question, seems to allude to it a little bit, saying that a small company paying out a dividend rather than reinvesting it is unique, which it is. And I know nothing about Massimo other than what I've heard tonight, because I haven't followed it before. But something that I would be interested in looking a little closer at
me too.
is, I like the company, but this dividend question, is this an instance of management being very, very honest with its shareholders and saying, hey, we've run up this cash, and right now, quite frankly, we can't invest the cash productively at the level of return that we expect, and we're not going to sit and hold it on the balance sheet and invest it at 0.1%. We're going to give it to you. And similarly, we're not going to go around looking for some bogus acquisition to dump it into. So, I look at it as a possible positive, one of those intangible positives for management.
Yeah, the other idea would be that a share buyback program is something management does. Claiming that if people are holding the stock for a short period of time, they're going to pay, I think, normal income at tax rates, right, rather than the long term for dividends, which is 15%, I think. Yeah, so
and they're talking about buybacks here on the Value Line report too. So it looks like they're probably going to do either or both. And that's the other thing. People often ask me about are buybacks okay, and my answer is real simple. If you follow what we do, buybacks are okay when par is high. If you find a company that's doing an extensive buyback when its par is low, they don't know what they're doing.
Yeah, well, most companies do it at the wrong time, it turns out.
Mark, we're having a few people indicate they don't see the dividends on their SSGs with the data that flows through. You won't see it because these are special dividends, and it won't appear in Section 3 on your SSG.
Yeah, it's not in mine either. That's some Value Line data.
That's right. But, here's something interesting. I might actually just send an email to investor relations to the company and ask them that question, because it is a very good question. Why are they paying a special rather than a regular dividend, and see what they come up with. it'll be a canned answer, that really won't give much in the way of true information.
It's a smaller company. You might.
Yeah.
It's right down the road.
Get
right?
the CFO.
Yeah, if all of us send an email and ask.
Well, on your next trip to San Diego, you could just drop in. It's Irvine.
Yeah.
It's an Irvine company.
Yeah.
Let us know what you find out. No, it's a good topic. It's an excellent topic to actually dig into and explore in greater detail. But we'll do that.
Well, Mark, my granddaughter that normally goes to bed at 9:30 is dancing right now because it's 10 o'clock. So I'm going to sign off and wish you all well and try to put her to bed.
Okay, thanks, Ken. We're all going to
Good luck, Ken.
I'm ready to dance too.
There's a scary sight.
We'll leave you with that scary visual image. And, all right. Well, thanks, everybody. We're going to go ahead and sign off, and hope you enjoyed it. Thank
you.
Thanks.